There's a pattern that repeats throughout history. Empires rise because they create productivity, innovation, and trust. But eventually, many begin relying more on debt than production, more on financial engineering than real wealth creation. And at first, it works beautifully. Debt creates the illusion of prosperity. You can spend beyond your income. You can stimulate markets. You can delay pain. And because the system appears stable, everyone assumes it can continue indefinitely. But debt has a hidden law attached to it. Every dollar borrowed today eventually demands either repayment or devaluation. That's where things become dangerous. For decades, the United States held a unique position in the world. It didn't just borrow money, it borrowed money from everyone. Countries bought U.S. Treasury bonds because they trusted America's economy, military power, legal structure, and currency stability. The dollar became the center of global trade. And because of that, America gained something extraordinary: the ability to print debt faster than almost any nation in history without immediate consequences. But now cracks are beginning to form. Not because America suddenly became weak overnight, but because the math is becoming harder to ignore. The national debt keeps rising. Interest payments are exploding. Deficits are widening. And foreign demand is no longer as strong as it once was. This is the part most people misunderstand. The real danger isn't simply having debt. The danger begins when lenders start questioning whether the debt will maintain its value over time. That changes everything, because once trust weakens, governments face impossible choices. They can raise taxes aggressively, cut spending dramatically, or print money to keep the system functioning. Historically, most choose the third option, not because they want to, because politically it's the least painful in the short term. But printing money creates another problem: currency dilution. And when currencies weaken, people feel it everywhere: food, energy, housing, healthcare, savings. What looks like inflation on paper is actually declining purchasing power in real life. Most citizens don't study monetary systems deeply enough to recognize this happening in real time. They simply notice life becoming more expensive while their wages struggle to keep pace. That's usually how the cycle unfolds, quietly at first, then suddenly. And today we're beginning to see signs of a larger transition. Several countries are diversifying away from the dollar. Central banks are increasing gold reserves. Trade agreements are slowly shifting toward alternative settlement systems. These changes are still gradual, but historically, reserve currency transitions always begin gradually. People assume dominant systems last forever, until they don't. And when confidence starts moving, it often moves faster than policymakers expect. Now, this doesn't mean America disappears tomorrow. That's not how major shifts happen. The world's largest economies are incredibly resilient. But resilience is not the same thing as invincibility. History shows that once debt reaches extreme levels, governments become increasingly dependent on low interest rates and continuous borrowing. The problem is, higher debt eventually pushes rates higher because lenders demand more compensation for risk. And then governments enter a trap. Higher rates increase interest payments. Higher interest payments increase deficits. Larger deficits require more borrowing, which creates even more pressure. This is how debt spirals begin. At first, central banks can intervene. They can purchase bonds, inject liquidity, stabilize markets. But each intervention gradually weakens confidence in the currency itself. That's the balancing act. Save the debt market or protect the currency. Doing both becomes harder over time. Now think about what this means socially. Economic pressure changes behavior. When people feel financially secure, societies remain relatively stable. But when purchasing power declines and inequality widens, frustration rises. You begin seeing political polarization intensify. Distrust grows. Institutions weaken. This is not random. Economic cycles and political cycles are deeply connected. Throughout history, internal conflict often rises during periods of financial stress. People search for someone to blame. The wealthy blame policymakers. Citizens blame corporations. Governments blame external enemies. And societies become more divided exactly when cooperation is needed most. This pattern has repeated across civilizations for centuries. Now here's the uncomfortable truth most mainstream discussions avoid. Debt problems rarely end with simple solutions because the scale becomes too large. Once obligations exceed what can realistically be repaid through growth alone, systems usually resolve the imbalance through one of several painful paths: inflation, currency devaluation, financial repression, restructuring, or severe austerity. None are painless, and every option redistributes wealth in different ways. That's why understanding these cycles matters, not to panic, but to prepare rationally. The people hurt most during major transitions are usually those who assume normal conditions will continue forever. History punishes complacency. Now, one important point must be made. The United States still possesses enormous strengths: massive innovation, deep capital markets, global influence, powerful institutions, technological leadership. These advantages matter enormously, but even strong nations are constrained by arithmetic eventually. And debt arithmetic is becoming increasingly difficult, especially when economic growth slows while obligations continue expanding. This is why many sophisticated investors are paying closer attention to hard assets: gold, commodities, energy infrastructure, real productive businesses, not because the world is ending, but because they understand monetary cycles. When currencies weaken, scarce tangible assets often preserve value better than paper promises. Again, this doesn't happen overnight. These are long transitions, but long transitions create massive wealth shifts. Some people lose purchasing power for decades. Others position themselves early and preserve wealth. That's the difference between reacting emotionally and understanding the cycle structurally. And here's another critical point. The biggest risks often emerge when governments attempt to avoid short-term pain at all costs. Short-term stimulus feels good initially. Cheap money feels good initially. Debt-funded growth feels good initially. But eventually, future obligations arrive. And when they do, policymakers usually face a terrible dilemma: allow recession and deflation, or print aggressively and risk inflation. Historically, inflation becomes politically easier because most people don't immediately understand it as a hidden tax. But over time, confidence erodes, and confidence is everything in a debt-based monetary system. Without confidence, systems become unstable very quickly. That's why central banks monitor expectations so carefully, because psychology drives markets as much as fundamentals. Once people believe money will lose value, behavior changes. They spend faster, save differently, move capital elsewhere, and those behavioral shifts accelerate the cycle itself. This is why reserve currency status matters so much. It provides extraordinary flexibility, but it's also something that must constantly be maintained through trust, stability, and discipline. No reserve currency remains dominant forever. History has already shown that repeatedly. Dutch, British, now American. Every cycle eventually transitions. The only question is how orderly or disorderly the process becomes. And right now, the world appears to be entering a period where old assumptions are being challenged simultaneously. Geopolitics, trade systems, monetary policy, debt sustainability. Everything is interconnected. That's why understanding the bigger picture matters more today than ever before. Most people focus only on headlines, but the real shifts happen underneath the headlines, slowly, then all at once. So what should ordinary people actually do? First, avoid emotional extremes. Fear creates bad decisions. Blind optimism also creates bad decisions. Instead, focus on resilience. Develop valuable skills. Diversify intelligently. Reduce unnecessary debt. Own productive assets when possible. Understand how monetary systems actually function. Because in every major transition throughout history, informed people adapted faster than emotional people. And adaptation is survival. The next decade may not look like the previous one. The era of easy money may be ending. The era of endless confidence may be weakening. And if global demand for American debt continues declining, policymakers will face increasingly difficult choices. Choices that affect every market, every currency, and every household. The important thing is not predicting the exact date of crisis. Nobody can do that consistently. The important thing is recognizing the direction of the cycle before the majority does. Because once the crowd fully realizes what's happening, the repricing usually happens very fast. And by then, the opportunity to prepare is much smaller. That's the lesson history teaches repeatedly. Cycles don't end because people want them to continue. They end because the underlying structure becomes unsustainable. And when that happens, the world changes, not instantly, but permanently. If you found this analysis valuable, make sure to like this video and subscribe for more deep insights into economic cycles, wealth preservation, and the hidden forces shaping the global economy. The people who understand the cycle early are usually the ones best prepared for what comes next.